Let's just get started because I think we're a little bit delayed and we have a lot to unpack in this cross-chain panel. But hi, everyone. Welcome to Bridging the Chains, Interoperability in a Multi-Chain Future. I think this is quite a pertinent question in our space, and specifically for us. You know, it's a very near and dear topic to Tokka Labs. And I think we're long past the point where crypto lives entirely on one chain. Right? But while the number of L2s, L1s, app chains, and rollups have literally exploded, I think the question now is whether users, apps, capital can move across these ecosystems as if one single seamless environment. Right? I think that's the bigger question around cross-chain interoperability. And for us, at Tokka Labs, we basically experienced this firsthand. Right? We are cross-chain solvers. We're prop trading firms, so we experience this fragmentation pretty much on a day-to-day basis, routing capital across different chains, optimizing for latency, liquidity, execution risks. So very, very happy to have what I would think, especially in our space, like one of the three of the largest, biggest names in cross-chain today, starting with Domink from Li.Fi, Sushant from Wormhole, and Fig from Squid as well. So very, very quick round of intros. Name, project, what you guys are building, and where you sit in the interoperability stack. Maybe Dominic can start with you.
Hey, I'm Dom. I'm the head of ecosystem at Li.Fi. We are a liquidity aggregator, aggregating cross-chain bridges, same-chain liquidity sources like DEX aggregators and solvers, as well as token standards, so any type of like messaging, mint and burn tokens. Yeah, we've been around for about 4 years. We cover 50 plus chains, including Solana, Bitcoin, Sui. And yeah, that's it.
Cool. How about you, Sushant?
Hey, I'm Sushant. I work at the Wormhole Foundation and I do strategy. So I lead network expansion as well as our Intents product. Wormhole is an interoperability protocol that allows for bridging of assets as well as messages and just allowing basically shared state between chains. We started 4 years ago, and actually our first ever product was a bridge between Ethereum and Solana, the very first bridge between Ethereum and Solana. But now we're live on over 40 chains. We obviously are live on a lot of EVM chains, but alt VMs are something that we're really crushing at the moment. Yeah.
And my name's Fig. I'm one of the co-founders of Squid. And we're a cross-chain API and UI for swapping between. As of just a few minutes ago, we crossed 99 to 102 chains. So we're on 101 chains. We just launched XRP and the XRPL EVM today. And we're a liquidity aggregator as well, like Li.Fi, and we've got our own protocol for intent. So it allows market makers like Tokka's solving on us to allow people to swap between any token on any chain in one click.
All right, let's start with the broad thesis, right? Everyone here is building on the assumption that the future is definitely multi-chain. But are we 100% sure that this is definitely the case? Because one thing is that interoperability is definitely getting better. But I think so is the argument for consolidation, right? Lower complexity, better UX, fewer attack surfaces. So I want to hear from each of you guys your take. Are we going to see chains connect more deeply and persist, or are we actually going to see convergence towards a small number of winners? Maybe open to the floor.
I guess I can probably start. I think, if you go back to, let's say, 2017, the thing that everyone was talking about was becoming like an ETH killer. Like there was this whole thing, EOS raised like $4 billion and did nothing, but that's a different story. And there were a bunch of other chains that were promising all sorts of things. Alt VMs were just the de facto standard. EVM wasn't really the default like it is now. But then as time went on, it kind of consolidated into just Ethereum and to some degree just Solana, right? Between, let's say, out of 2021, the market kind of died, and then 2022, 2023, somewhat of 2024, it's pretty much just ETH and Sol. Obviously, the L2s kind of, came into the picture around 23. But now, as time goes on, we're kind of going, we went from a ton of different chains into, just 2 or 3, really. not counting Bitcoin, let's say, at least as far as DeFi is concerned. And then we went back into like tons of chains, and everyone was launching an L2. But I think now actually this is probably the place we're going to stay, simply because a lot of these institutions are actually running their own chains, right? You know, there's this whole thesis of like, why not just have your own stablecoin? Athena did a really good job of popularizing the idea of basically making a vault token a stablecoin, and now everyone who has any meaningful size fund is like, oh, instead of just tokenizing this, we can just make it a stablecoin. And we're seeing the same thing happen with chains. Obviously, JP Morgan has Connexus, their own chain. You know, Fig just brought up Ripple, and we just announced that we're canonical for both of those two chains, or whatever you want to call it. But then even like chain, like, you know, if we go into the east as well, like Ant Group, the parent company of Alibaba, Alipay, etc., they have their own chain. Hashkey Exchange is another one out of Hong Kong. I mean, I can just start smashing out a bunch of them. But I think because all of these, you know, institutions are like, why have value leakage at all when we can centralize the entire stack to ourselves? And so I think that's just inevitably going to be the de facto standard moving on. And of course, you know, we have Securitize, a great example. You know, they had BUIDL, their money market fund, on Ethereum. They went to Solana via Wormhole. But now they have their own chain, Converge, because why not? And so I think that's just going to be the case from here on out.
Yeah. Yeah, I think we're in this, like, as you said, like this expansion phase where everybody is launching their own chain. I think a lot of the early chains that we've seen, or like specifically L2s, were kind of like everybody launched an L2 because they kind of could, and they could raise money for it, and they didn't really have an idea of like what specifically to do with it. A lot of them were also just showcases, right? If you think about like the Arbitrums, Optimism, CK things, a lot of people are like, oh yeah, but like why launch these chains even? But I mean, at the end of the day, these chains needed a showcase to like show their stack, and then you have, you know, the bases and uni chains of this world coming afterwards, and they are actually building applications on these chains, or the asset issuers are building actually applications on these chains, and I think we're quite early to that. I think a lot of that is just happening right now, and I think it's still to be determined if that will be successful in the future. Will look like everybody will have their own chain, or at some point people realize that doesn't really make sense and go back to you know, concentrating onto a smaller number of chains, or like roll-up stacks that are more tightly integrated.
Yeah, I agree with both those points, or all of the points. I would add that I think interoperability is actually the key to this expansion, and how the asset issuance and application layers are going to develop. I think originally with MetaMask and Ethereum, it was a lot easier to have interoperability between apps because everything was just on one chain, and you could sort of bring your own wallet. It was magical. You could use the same assets in Aave as Uniswap, as like Compound, and I think we've realized that just isn't possible in a multi-chain world. And with Intents as well, all the logic is coming off-chain, and you know, market makers are doing all of the exchange logic they need off-chain, and the apps haven't really been able to create a user experience which works in the same way that MetaMask did on Ethereum. So I think chains are going to tend towards just being essentially asset issuance, and then app chains, things like Hyperliquid, where you do really need just a chain for perp stacks, but it's pretty rare. Maybe like big companies will end up launching on Ethereum just because it's secure, but we're not really seeing that happen. So I think we'll end up with a lot of different blockchains for almost compliance and like, what's the word, like value accrual reasons, but that's all. And then all of the application logic is just coming off-chain with Intents, and we'll be able to move between it via market makers.
That's super interesting. It does seem that there is no kind of like firm answer on it, right? Different use cases will want convergence. Different use cases will want various centralization of chains, as Sushant has kind of mentioned. So much to unpack, but again, there's so many good things that we're going to talk about. And you know, obviously, you guys stay around and unpack it with the panelists after this panel. But one key thing I think, again, very close to Tokka Labs as a business is, of course, where the revenues should really come from, right? I mean, this is something that we think a lot about, obviously, at Tokka Labs, where we're operating our cross-chain strategies, bridging assets, abstracting gas, paying MEV or relayer costs. The fees stack up pretty quickly. And yet, I think the general consensus is that nobody wants to pay them directly. So in your opinion, right, who really, or where should this economic burden really land? Or is it like one single responsibility? Is it a combination of a lot of different things? What have you seen worked in your ecosystems?
So yeah, I think like generally the problem that all actors have that act in the interoperability ecosystem is that there's a lot of different players in the market, and as it's like an emerging market, very heavily VC funded, nobody wants to pay for anything. Nobody wants to be charged. All of the players that have the distribution to give you the order flow that you need, they know that they have the order flow and they know that you need the order flow. So so basically what I'm saying is the biggest people that make the money and have the biggest advantage from interoperability right now are the people with order flow. Yeah. So nobody makes more money from, I mean, maybe, but like I would say like nobody makes more money than, for example, like a Phantom wallet, right? Because like they charge 85 bips flat on like every cross-chain transaction that's happening, and everybody below that is like, yeah, but we also would like to make some money. But at the end of the day, they control the user, they control the user interface, and that goes for all the other big players in the market. And obviously, Squid has their own interface. We have our own interface, but like we don't have that same level of user lock-in that like a Phantom, for example, has. So this is where currently the value accrual sits. It sits whoever is closest to the user, and that's why everybody's trying to go closer to the user. And then potentially the Wormholes and Layer Zeros of this world could monetize on the asset transfer, but none of them want to do that right now because they are at war with each other and trying to get more asset issuers to use them, and if they charge fees, then they would just be outcompeted by the others. But at some point, they're gonna have to like figure that out because they're gonna run out of money otherwise.
Yeah, that's why I kind of pass it to you, because obviously you know very well about switching costs are effectively zero, right, in interop, and in bridging as well. At the end of the day, if you can provide the best pricing, speed is less important, but speed is important too. But if your pricing is off the chart, like no one's going to use you. Obviously, there's a front-end distribution piece that Dom just mentioned. I mean, just another data point. Phantom charges 85 bips. Ledger can charge as much as 150, right? And then if you go to Telegram trading bots, some of them are charging 1%. And they're making like tens of millions a year, and like people don't even know about them because their UX is just orders of magnitude better than anything else you can get on the market. So users are very happy to pay that much. But then when it comes to the infra side, it's like this is not something that users actually use, right? They're using things that are built on top of the infra. And to Dom's point, yes, on the asset side, although I would push back, but I'm kind of incentivized to do so. A lot of the reasons why assets kind of use Wormhole is more on the security side, less than pricing. But to your point, you're right, like switching costs are effectively zero. Like, there are auxiliary reasons why like certain interop providers are better than others, obviously subjective. But at the end of the day, all that the interop provider is offering is shared state. And so if you can do that as effectively as someone else, then the moment you put even like 0.1 BIP, it's like, well, that one's free. And it's the same with bridging as well. Like what we've found, and a lot of our obviously order flow comes through you guys, is that it's just pricing at the end of the day. Like what kind of shows, and obviously that logic can be based on the aggregator's will, whether it's Squid or Li.Fi or otherwise. But at the end of the day, all the user really cares about is, will I get the most out as I put in? If I'm losing like 5% to fees, I'm not going to use that anymore. I'm going to go somewhere else. But obviously, if you have distribution, that's where you print effectively.
Yeah, I'd echo those points again. I guess the thing I could add is that maybe the layer that Tokka's at is also able to make money. I think similarly to normal markets where market makers are fighting on fractions of a bit at very large volumes. I think they can that's a really power law distribution. Maybe only a few people actually ever make money, but there's an opportunity there too. I think the protocol layer where the three of us are at will probably go to zero and stay there because it's just so easy to change providers. And it's a feature of crypto really that they can. That's why this technology is so cool, is that it gets rid of middlemen. And currently we're not middlemen because we're not charging any money, but we are kind of in the middle. Yeah.
We're unpaid middleman. That's the new middleman in crypto.
That's the future.
You are important middleman, that's for sure. That's for sure. I can attest to that. Okay, let's talk a little bit around the infra as well, right? We've talked a little bit around the whole ecosystem in general, where we see it kind of going, the revenues, so on and so forth. To touch a little bit on infrastructure, I think almost every interoperability stack promises to be four things, right? Secure, fast, cheap, user-friendly. But rarely, I think, do we see all four delivered at once. And just to add on to this point, literally today, earlier on, I was on a panel at Multi-Chain Day with 4 different L1s, all with different things. And they almost always mention like up to the 3 and then never mention the 4th like tenet, right? So I do think that, it's difficult. It's a difficult thing to do. For us, at Tokka Labs, when we pick infra, I think we're often forced to decide to, 2 or 3 things that matter most to us, generally around speed and predictability. So I am curious with you guys, do you guys think these 4 fundamental tenets are still kind of like at odds with each other, or are we finally seeing a lot of stack come out where, yeah, actually it is possible to be secure, cheap, fast, and user-friendly?
I'll go first. I mean, I think it's possible now. I think there used to be this dilemma, but now Intents have really solved it. I mean, we can have the market maker has to take on the risk, but you guys are experts in pricing risk, so that's who should be taking on risk of a bridge failure. And then also there's a very short time period that your assets are, for the user at least, that the assets are at risk. So it's secure, it's good UX, it's fast. So I think with Intents it's possible. Maybe at the core interrupt layer, like you could probably talk about it more, but like ZK and like speeding up the security. Even because of Ethereum finality being quite long, I don't know if it'll ever really be solved, but yeah.
Yeah, I mean, actually, we'll probably speak about ZK a bit later, but I think the biggest limit with ZK is like, how long does a proof take on Ethereum? Like 5 minutes or something?
Yeah, that's like in the future, but yeah.
So like that's not speed, right? Like obviously you're maximizing security, but like speed kind of goes out the window. But up until now, I don't like, what does user-friendly mean from an interop perspective? I don't think it necessarily applies, or rather it does apply in the sense, you could argue that dev experience is part of like the user-friendliness, right? And there's a lot of feedback just from like integrators where it's like, this SDK is better for this reason and that SDK is worse for X, Y, Z. And we've actually seen a lot of that. So NTT, which is kind of like our native token, not kind of, it's our like multi-chain token standard effectively. So Biddle from Securitize uses that, USDS goes from Ethereum to Solana using that, and a bunch of others. Originally, it was a really involved process to kind of make your token multi-chain using Wormhole. Jito Sol was the very first token that did this, and it was a very long process and a lot of back and forth. But then as time went on, then we introduced a CLI, which obviously doesn't like make it super easy. There's still a lot of like work to be done, but it kind of shortened the timeline to integration from like, let's say, a week to a day, for example, and reduced the amount of engineers and just resourcing required. And then like very recently, then we launched this thing called the Entity Launchpad, where like literally anyone with zero tech knowledge can make their token multi-chain. And so that was an over 12-month process to kind of make the protocol more user-friendly, because as we found out, taking a token cross-chain is something that's very, very important. So actually I said, I don't know what that means, and I kind of gave a justification as to a way that can happen. And then on the security side, just one comment as well. That's something that we kind of don't negotiate on whatsoever, and that does to some degree affect our speed to deployment. Obviously, we're not live on 150 chains, but it's by design, and that non-negotiable is like our Guardian network, where we kind of derive our security from a set of 19 validators effectively that are all institutional, KYC, like huge company like Chorus One and Rockaway X, et cetera. Sorry for naming a competitor. And one of the big things that a lot of our institutional partners look at is like, if anything goes wrong, we can sue them. You can't sue a smart contract, right? And so that's one of the reasons why we've been so successful on the institutional side, is that we've kind of merged. Obviously, there's on-chain like smart contract security as well as a bunch of other things you can do. But just something as simple as like having parties to point fingers at is actually something that's super, super important for TradFi if they want to come on-chain, which is why I've had so much success. I'll stop there. I'll let Dom add.
Yeah, I think I agree with both of you that like in terms of the interoperability layer, as in messaging, and the kind of like intent layer, as in like individual intent protocols or solvers, I think we've come a long way as to make this whole thing much more user-friendly. I think what's still difficult is kind of the UX layer that we operate on, which is taking all of these different third-party tools, taking like that entire stack and packing it into one API. And because like, I don't think you guys would believe the amount of like protocol upgrades, API upgrades that all of these tools constantly do. Like 75% of our engineering work is just maintaining what we have, right? And all of our integrators, they constantly want another liquidity source, a new chain, this new bridge. Like, I mean, we all think like that interop is solved, but somebody still keeps funding another 20 cross-chain bridges for some reason. And there's always somebody who wants these integrated. So we have from our perspective, it is still really difficult to basically deliver you the best UX and the best price. The best price meaning I have basically taken a look at all available on-chain liquidity sources and I've routed via all available pathways and given you the best possible route. I think that is still a pretty huge undertaking, and an undertaking that is just going to become harder with time. You know, it's like kind of like, think about it like from perspective like a sky scanner. The more airlines are launching, the more different flights exist across different airports and places you can go to, the more available routes there are and the more things you have to track. So that layer of the stack, trying to give a end user, in our case would just be a B2B company most of the time, access to this entire on-chain world, abstracted away into this one simple offering, I think that is still difficult, even though we've obviously also come like really, really far in terms of adding liquidity sources, chains, how fast we can add them, how we monitor them. But yeah, I think there's still a lot of work to be done on that end, but I think on the lower levels of the stack, we've kind of come to a more settled consensus of like what works and how it's supposed to work.
No, that I think you guys have unpacked a lot in that question, and I think a lot of it is very much like relevant for anyone kind of using in the day. And it's quite interesting because I think for most of the conversations, especially on chain, and this is directly comparing to the first multi-chain panel that I did this morning, their concern about interoperability was very much more from a how do we get a user, from the user perspective, right? And less about the technical integration. They're very firm about, we've talked a lot about technical integration, so it's very good to also hear from you guys who are building the tech that there's still a lot to do. We've come a long way, but it's still a lot to do. Okay, we talked a little bit about ZK. Sushant, you touched a little bit about that. Obviously, I think we're kind of like, ZK is like, with tethering at the edge, right? ZK is like, here, neither here nor there. It is evolving fast, offers some interesting guarantees, for sure, for cross-chain messaging, proving off-chain execution, things like that. But as Squid has kind of mentioned, intent-based systems are definitely pushing in pretty much the opposite direction of ZK. Extracting how something happens entirely. So the question is, are we heading towards a ZK dominant world, or will intents define the UX of the next wave of apps, or is it like a hybrid model that will exist at some point?
I think that ZK is not as needed, yeah, because of intents. I mean, we already have someone to sue, so why would we give we give that up? It's not as needed, but I mean, I'm super excited by ZK generally and like how crypto has funded the progress of it, but I'm not sure if it's going to be the thing that changes interop. Maybe it has some improvements here and there, but yeah, it's not super necessary.
Super quick follow-up question, because you mentioned earlier, you and Sushant mentioned earlier about the fact that the speed of ZK is obviously the biggest gap. Well, not the biggest gap, but like one of the gaps in comparing it to intents. I wonder if there's an upside to ZK that will either complement or supplement intents-based systems.
Well, I guess there's two ways to think about it. One is like ZK from the perspective of the transactions themselves, but then there's also the application of ZK, which I think has a lot more kind of application in the immediate term. I mean, just data and being able to prove X, Y, and Z without having to, I mean, that's like the stock standard like value prop. But like there's chains like Mocha, for example, which is kind of like Animoca's identity chain that is like building this as we speak. So it's, of course, like I mentioned, it's like, thanks for correcting me. Like my understanding was like, if you want to do a ZK proof on mainnet, it takes like 5 minutes. It's actually like much longer than that. And it's like, oh, maybe eventually we'll get to 30 seconds, and then maybe 10 seconds, and then maybe 5, and then maybe 2. But it's like the amount of like capital resourcing and just like computational capacity required. It's like that might be a future where everything can just be ZK by default, and there's like no trade-off whatsoever. But I think that's like very, very, very far away. And the immediate term, like Fig said, being able to sue someone is just way easier,
Accountability, I think, is very, very valuable. Domink, any thoughts?
Yeah, I think, there's obviously some, there's a lot of the players in the market that are talking to all the ZK providers and seeing if there's proofs that can improve their products, be it on the intent layer or be it on the messaging layer. I think that is interesting, and the power laws of proving times coming down and becoming cheaper, they're just gonna keep on going, and at some point that will make sense. Another thing that's really interesting from our perspective that could potentially happen in the future is, in a way, like Li.Fi's routing right now is back-end routing, right? Like we ping all these APIs, we have our routing algorithms that find pathways. But basically, at the end of the day, there's a trust element there where Li.Fi says this is the best path available, and you kind of have to trust us. So there could be a future where we can start basically proving these backend outputs, and then you have a verifiable routing. So that's something that's really, really interesting, I think. But also still probably a pretty long time away till you can actually make that happen. And also the question, is the user willing to basically pay the extra proving cost of having this routing?
I was just going to add on to that. Is that even necessary if the user is happy with the price, right? Do they need a proof? If you can guarantee the price, then I don't think.
Well, in a way, our system right now is optimistic in the sense that you just assume that it's the best, right? And similar intents, we have seen optimistic systems win. I think I think obviously we're in crypto, which comes from the word cryptography, so we're kind of obsessed with proving anything or having massive security attached to anything. A lot of chains are debating now if they should slash their staking rewards by 75% because they think we're basically overpaying for security. I think a lot of the stuff that's happening here, maybe adding to what we said earlier, is we actually think there's a percentage on the smaller end of transaction sizes where users might be completely comfortable using centralized routes, or for example, instead of using an intent system, which obviously has some message passing and verification attached to it, I could just ping your solver directly if I trust you, and that's going to be much cheaper. And if I'm doing a $500 transfer, I might just want to do that. We've all seen Relay become super successful with basically decentralized design, because what we've seen is for a lot of paths and a lot of transaction sizes, the user doesn't actually care about all of these things that we're doing. And that's a bit frustrating maybe for us, because like we've built all these systems. But I mean, that's at the end of the day, we got to meet the market where it's at. So there's going to be probably a like kind of verticalization of different transaction sizes, different security guarantees.
Just one thing to add to that. While I do agree that the user necessarily doesn't really care, the distribution providers do. And so because you brought up Relay, so Relay used to be integrated by Phantom and did a lot of their volume, but because of how centralized it is, Phantom got rid of Relay. And if Phantom is the one that determines which users get access to those routes, then being able to kind of align with what they deem as secure, centralized, or otherwise is also important. And that's like a great case study right there.
Do you know why Phantom disintegrated Relay? I didn't know that.
Because they're super centralized.
But was it like a regulatory reason? Because the UX is better.
I think it was just they weren't comfortable with it. I obviously I can't speak for them. But yeah.
I mean, there's multiple. I mean, we aggregate Relay, right? There's multiple like institutional clients that are not necessarily comfortable with using such a system. I mean, from our perspective, that's not really an issue because our API is by design modular. You can whitelist or blacklist any liquidity source, and a lot of our institutional clients, they only use a very they mostly use that blacklist or whitelisting function. A lot of our small integrators, they just go with whatever is available in terms of liquidity. Yeah, I mean, that's not necessarily a problem, I think, because there is enough other providers that do feel comfortable, and there's enough end users that do feel comfortable with it. So I agree with you, but that doesn't necessarily like invalidate my thesis.
No, yeah, I know, I completely agree. Just kind of giving a counter example of that also not playing out. But yeah, for most users, if you're sending $100, like who cares, right?
Yeah, I think maybe from a Tokka Labs perspective, we can probably give a good view on that because we're obviously the solvers on all these different orders, right? For like, I wouldn't say Phantom specifically, but like the Phantom level of like distribution, and then you've got your people who just want to swap $500, right? So I think, and it's really interesting because I think the distribution channels play a big factor. And it's a different use case. It's not like one's more important than the other, but obviously people with bigger distribution, they want more liquidity sources, and maybe ZK in terms of proving that this is the best price will be very attractive to these guys. But, you know, yeah, there is also people who just want to swap, you know, $100, right? And are willing to just, you know, just go directly with one solver, for example. So I think they're all valid points for sure. But it really boils down to, like Dominic, what you said, where the market moves towards and where you meet them at. And it could be a case where it's complementary, right? You know, some people are serving the guys who want to swap $500, and some people are serving the Phantom wallets, and they're both equally important, right?
Yeah, I mean, for the way that we segment the market, like roughly in our head, is like 0 to like something up to like $10,000, but more likely like $1,000 to $5,000. People are pretty comfortable with like low security guarantees. The like $5,000 to $10,000 to $100,000. Mostly like intent-based systems, because that's also like the sizes that solvers can serve. Yep. Everything above that will most likely go via like Entity, Wormhole, like other messaging providers. Because if you're sending $500,000, you probably don't care if the settlement time is 5 or to 10 minutes if you have those security guarantees.
No, absolutely. We are running a little bit low on time, so I will kind of go into a couple of things very, very quickly. I think two last questions. Number one, I think we haven't talked too much about, or we have a little bit, but what do you guys think are the biggest kind of unsolved UX and developer friction points in cross-chain infra today? And, you know, speaking for ourselves, you know, Tokka Labs as cross-chain kind of solvers, this is definitely still a headache for us, right? So it's a day-to-day, and I think if any of you guys, and maybe not so much Dominic, but I think Sushant and Fig, you've spoken to me enough, and I think I've spoken to people enough to say that technical integration is the biggest bottleneck for us, right? So, you know, things like wallet fragmentation, relay coordination, gas extraction, there's just so many parts where the tooling just doesn't feel finished in that view. So, yeah, I mean, sharing from Tokka Labs' perspective, what about you guys? Where do you think like the top friction points for devs look like, or UX in general?
I don't know if it's devs or UX. and this might rub you the wrong way, but I think that for intense bridging especially, there needs to be more of a way for like regular users to be able to allocate capital to market making. At one point in time, solving, or probably still, was like probably not the easiest way, but like you could make crazy amounts of money just solving. If you look at some of the solvers for like a cross and like D-bridge, they're printing like over 200% APR on like 7 figs of USDC. There is no reason, in my opinion, that like only market makers should be able to access those yields. Obviously, people have tried to kind of democratize it, provide liquidity in an LP, like in Stargate equivalent, effectively. But for solving intents, but I haven't really seen it, or maybe I've just missed it entirely. I haven't seen that really play out in a way that's gotten much traction. There is a protocol called Eco, which is specifically focused on stable coins, and they've got this idea called crowd liquidity, which is trying to do that, but at the end of the day, if you're starting a brand new bridge, you need distribution. So I think that's probably the biggest gap that I see. Like, I want to get that yield.
Yeah.
Can I follow up with something on that, though? I've seen that, like, we work with Echo. There's a couple of other players who have these same ideas. We had these ideas too. Let me ask you a question. If there's a solver that can print 200% on 7 figs, why the fuck do they need to give capital to like the open? Like they can raise hundreds of millions of dollars of capital, lend that capital without having to make that publicly available. There's no upside for a competitive solver in sharing their capital with end users. Like that's a game theoretically that makes no sense.
No, yeah, the market makers should definitely not do that. Yeah, of course, that they have, like, why would they? They're making money. No, I mean it more from, like, the retail perspective. If I'm seeing these market makers make this much money, it's like, why can't I become partial to that?
Well, I mean, because they have the skill set. Like, that's the game, right?
Yeah, of course, but, like, yeah, right, that's their barrier to entry, right? Not everyone can become a solver. But that's kind of, I mean, the question was, what would you like to see? If solving becomes easy enough that anyone can run a solver, or alternatively, there's a way to have communal pools that run certain strategies for certain assets that anyone can attribute capital to and can plug into all of these existing intense bridges, that would be sick.
I think, I might be wrong, but I think there's a company called Sprinter that's doing that. I'm not too sure if they're doing it in this way.
Every company is doing that. I'm sure you guys are working on like something. Like literally every single company that does intense, including us, we're also going to launch an intense system soon, right, is working on this. I'm just not very bullish that that's going to play out in the real world.
No, I think both of you raised good points, right? I think from Sushant's view, it's more of like, it's a DeFi maxi view, right? Where it's decentralized, it's, it should be permissionless, But the reality is, market makers exist for a reason, right? Not everyone can build these trading strategies that are able to hedge risks away, and that should have some value in the space. But it is kind of like it's a very much almost like a philosophical question in DeFi, right? And now with a lot of TradFi coming in as well, it's becoming very much like, do we do permissionless? Do we do permission? We're seeing a lot of permission things coming into the ecosystem as well, which I think as a DeFi maxi might not be like the best thing, but there is definitely some upside to having that in, right? You actually get huge inflows. You get the liquidity that everyone is sourcing for finally is here, kind of thing. So it is very much like you can go on for hours debating about it, I'm sure.
And just to steel man my point as well, I've worked with countless solvers at this point. A lot of them, they can operate a solver on EVM, no dramas. They can land transactions every day, all day, no dramas. As soon as Solana comes into the picture, they just lose the plot entirely. So even if we're talking like institutional grade market makers, talking about just landing transactions on Solana, they can't even do it. Don't get me wrong, this is a very pipe dream.
Yeah, I mean, it's also one of the other things that I'm very worried about with this is adverse selection. Basically, it would be very easy to have a bunch of toxic flow to be basically, with these kind of pooled strategies, you end up with a toxic flow situation where you're actually burning a bunch of money instead of making a bunch of money. And I just don't think that a retail user is anywhere close to understanding the complexities of this to be able to make these decisions. I think there's better players in the market that can provide their capital than like retail users. Like ecosystems, for example, could do that. They have the right people, and that would still be potentially accessible. But yeah, I mean, maybe we'll see a firm who ends up like doing this for whatever reason, because they can do it. But I'm a bit skeptical.
Vig, any thoughts?
Not much to add. Other than I thought while you were talking about that this is a bit like Bitcoin becoming an ETF and being like bought by governments. It's the equivalent for DeFi. Like we made it, but we kind of ruined it along the way. At what cost?
Yeah, no, it is definitely something that I have so many thoughts on it. We can have a completely separate panel on just this topic alone, because there's so many players, right? You know, there's ecosystems, there's regulation as well, which we haven't even talked about, and then there's also, you know, accessibility to retail users. But okay, let's wrap it up very quickly, because I think we're really dragging on time. Obviously, everyone wants to know like future thoughts, right? But I think, you know, let's be all realistic. Let's just jump a few years ahead, 2030. I think some of you guys already mentioned earlier about some of the pain points that you don't necessarily foresee being solved. But yeah, maybe each one of you, what do you think will still be quite messy in interoperability or cross-chain ecosystems in general in the next 5 years?
And 5 years, I hope there's not much left, really. I think, I mean, we're going to see so much solved in the next year or two. So the app layer is the biggest thing I think that needs fixing. Like we built to solve cross-chain swaps from the beginning, not bridging. Like we're not as interested in bridging USDC, but none of the apps have really worked it out that you can just have an app which you can swap between all the tokens without needing to go actually do any bridging. But I'm seeing that happen like a lot right now. So like the app layer is going to become really cross-chain in the next year, I think, and then maybe the institutional entrance will need some working out. Like we haven't worked out how to go between permissioned and non-permissioned domains. I think that's the other big thing that hasn't been solved.
Anyone else want to add on?
I think the biggest issues are still in like uniformity between like non-EVM ecosystems. Like as you said, like I mean we've been doing that for a couple of years now, like unifying the experience between like Solana, EVM, Bitcoin, having to use multiple wallets, potentially, you know, like abstracting that away. I mean, I guess we're seeing it in a way happening within the non-custodial wallets, specifically the mobile versions of them, like a Phantom or a MetaMask. In a way, I think like all of these things, like account abstraction, signing, bridging, that it's kind of like all is going in the same direction, which is this like unified toolkit to interact with the on-chain economy or whatever we want to call that. And I think that's all gonna kind of like merge into one product, which is like everybody operating on the higher layers of the stack. And then, yeah, the wormholes of this world are probably more gonna stay low-level asset issuance and the deeper messaging layer and like direct chain integrations. Maybe even launch their own chains or their own roll-up stacks at some point. I could see that definitely happening. But yeah.
Sushant's like, no way.
I don't want to contribute to this mess that is multi-chain. Honestly, they said it all. I don't really have anything extra. I mean, Dom touched on the actual infra part. Fig touched on the actual app layer. I mean, like, what's left? Well, actually, this is kind of bad to say because it does benefit Wormhole. But I'm hoping this whole, like, everyone launching their own stablecoin kind of calms down a bit. Because, like, from the user perspective, it's very hard to have, like, everyone wants to be collateral, everyone wants to be ubiquitous, everyone wants to be able to print 50% APR without incentives. Obviously, it's, like, frothy, and then that'll calm down in a bit. I think and it's good, because obviously then, you know, that's how you get all the institutions to be like, oh shit, we need to do something in the space. But hopefully in 5 years, we've kind of figured all of that out.
Cool. Look, this has been a great panel, I think. You've definitely a lot to unpack, and hopefully we can do that at Token or something along those lines, you know, part 2, 2.0. But thanks so much for all of your time today. Thanks so much for being a great audience. Obviously, the panelists are still around if you guys want to unpack anything that we've talked about today. But yeah, thank you so much, guys.
Thanks,
Thank you.